Welcome everyone to Markaz House Views 2021 webinar. It's great to have you. I'm going to do a small introduction for those that don't know Markaz or not very familiar with it. And then we're going to move on and jump right into the event. So for those who are not familiar, Markaz is an investment company in Kuwait, launched in started in 1974. We listed on the Kuwait Stock Exchange in 1997. We've known to be the first to introduce options in Kuwait Stock Exchange, REITs in the early 2000s, listed in the Kuwait Stock Exchange, and a lot of other interesting products. We were among the first to have a fully owned subsidiary in the US that focuses on real estate. And in 1988, our current CEO, Ali Khalil, joined us back then to head our US subsidiary, moving on to 1997 to the Kuwait office to build it after the invasion to be what it is right now. So with that short introduction, I'm going to move on to Ali Khalil, our CEO.
Thank you very much, Abdul Latif. I hope everyone can hear me well. Good evening, everyone. And really, thank you very, very much for taking the time to join us tonight. Our webinar today, we intend to share with you our views for 2021 at a very critical time, when the whole world is disrupted and we are trying to help us and you and everyone that is attending to make sense out of it all. First, let me share with you, Abdul Latif said I've been here since 1989, and I feel like we've seen it all, and even I saw basically the Suq al-Manakh back in the early 80s. And the lesson learned from the several economic crises that we have weathered so far is to be sustainable. One needs to have a great attention to signals, i.e. market signals, geopolitical signals, the agility to analyze very quickly and act upon it, and the liquidity, which is the means basically to reallocate assets to match the convictions. That's exactly what we try to do at Markaz. This is why we're still here. We are research-based. We question our views and conclusions constantly with every new event. We don't stick to our beliefs. Our beliefs change basically with market conditions, but our values stay the same. We can collaborate internally and externally to exchange ideas, and we bet our money on our convictions. We do not just advise our clients. The coming period will be challenging to say the least. There will be great discrepancies in performance within the sectors and between companies within the same sectors and across economies. There will be winners and losers. There will be those that can transform, adapt, and thrive, and on the other hand, those that will not and disappear. In brief, the coming period will be characterized by the following. First, uncertainty will remain the driving trend across all asset classes, resulting in very high volatility in the near future. The driving factors will be complex geopolitics, technology and its impact on economies, on sectors and specific companies within the sectors. And mostly, how will we adapt to the COVID phenomena, among others? Two, asset class diversification is critical. So many factors are at play that it becomes very difficult to predict and bet on a single trend. Agility and liquidity, as I said before, to move across asset classes will be critical to managing risk. And finally, active managers will add value to portfolios, definitely the good ones, to benefit from the discrepancy in performance across companies and sectors. During the next hours or so, you will hear the views of our investment managers related to their respective asset classes. You will start with the Mena Equities. This team is one of the longest acting and managing team in Kuwait. It is the first to launch a mutual fund in Kuwait starting in 2001, which was Mumtaz. It also launched the first equity traded options back in 2004, ahead by decades of the GCC markets. Then followed by the fixed income, the team manages a bond fund and customized portfolios in bonds with a track record that is over 10 years old. Our MENA real estate team manages approximately 200 million dinars in real estate, including the first REIT in the region, which I remind you was launched in 2003, 16 years before the regulation was put in place in Kuwait, and definitely about 15 years ahead of other markets. Its dedicated team is present in Kuwait, Saudi Arabia, and the UAE. Our international real estate started in the late 70s in the US, as Abdul Latif said, and has managed income funds as well as development funds since 1989, with a continuous and outstanding track record since then, supported by our real estate arm, Markaz Management in the US. Our activities covers the US, Germany, Poland, and now last year, lately the Netherlands. International Investments has collaboration with outstanding investment advisors, provides global asset allocations and efficient execution. With not much to add, I pass on to the team to basically share with you their views. Thank you very much.
Thank you. We'll move on to Raghu to moderate.
Thank you, Abdul Latif. Thank you, Ali, for that good context setting for what I consider to be a very important webinar. This is a very important webinar because it is trying to look ahead and guide clients as to how to look at the noise that is surrounding us thanks to the COVID disruption, as you rightly mentioned in your opening remarks. This is arranged in such a manner that we are going to be focusing purely on asset classes, starting with Mena Equities, and then we'll also talk about fixed income, and we'll talk about real estate in the context of MENA as well as global, and we will talk about global markets because clients might have questions regarding global markets. For each of these asset classes, we have drawn experts from the respective fields to come and share their findings and outlook and opportunities. And if you have any questions, please feel free to pop them up on the chat box, and we will then pick up those questions towards the end and try to answer. Since we have a lot of ground to cover, let me get started first with Mena Equities. I have my colleague Fahad Al-Rushaid, who is a manager in the Mena Equities department, who will be presenting. I know we have a very strong leadership position in Mena Equities. We have won many awards, but we are also in the midst of the most challenging times when it comes to the regional equity markets, which is quite literally connected to the oil price. While global markets have seen a seesaw, the GCC markets haven't witnessed a sharp recovery yet. So the question on the top of the minds of people is, what would 2021 look like from an equity call for the regional markets, including Kuwait? And this is where my colleague Fahad will share. Fahad, you may please take the floor, and you have 15 minutes to share your findings. Thank you.
Thank you, Raghu. Thank you, everyone, for joining us today. I hope we'll be able to give a good outlook about equity markets for the coming year. Moving on to the next slide. First, before we give an outlook of what we think, how we think markets will perform in 2021, we'd like to start by analyzing what happened in 2020. And before that, we'll start with 2019. The MENA markets in 2019 had an excellent run, and before starting 2020, they ended 2019 approximately the S&P MENA benchmark on a gain of around 12 to 13%. However, the start of the year, there were some geopolitical events that caused some turbulence. And then come February, by the end of February, the COVID pandemic started to gain ground, let me say, and spread among Europe and the US, and markets started to lose towards the end of February and mostly in the first 2 weeks of March. Markets reached the bottom of loss of 23% for the Mena GCC Mena benchmark. However, very quick and unexpected rebound in markets took place, with the Mena benchmark ending the year on a gain of 1.5%. We honestly did not expect the quick rebound to take place. However, markets acted very quickly. Markets were looking at sectors that, investors were looking at sectors that would gain from the pandemic, and then started looking at 2021 and 2022 earnings very quickly in the year. And we saw a rebound that started 20th around the end of March and was one-way rebound until the end of the year. Performance within the GCC was mixed. Saudi was the best performing market, driving, which is the majority, has the largest weight in the benchmark, in the Mena benchmark, drove markets very well, ending the year on a gain of 7% approximately, followed by Qatar, which was up around 1%. And then the UAE, previous slide if possible, and then the UAE, which was down 2.5%, and Kuwait was the worst performing. Slide 4 if possible, please. And then the Kuwait, which was down around 9% for the full year, despite the MSCI event that took place towards the end of November. Saudi, it was extremely unexpected, the positive performance. First of all, the earnings decline was more than other GCC markets. Second of all, increasing austerity measures in the form of higher VAT, which was tripled in June from 5 to 15%, higher custom duties in the same time, and the suspension of the cost of living allowance all took place. However, there was other stimulus to compensate the austerity measures in the form of deposits for banks, in addition to compensations for private sector employees. All helped drive the market. We also witnessed a huge spike in liquidity in the Saudi market, around 100%. The market averaged a daily traded value of 7.5 billion riyals in 2020, compared to around 3.5 billion riyals in 2019, and a 10-year average of 5.3 billion. So an increase of 100% to volumes traded in 2019, and an increase of around 30 to 40% compared to the 10-year average. Qatar proved a lot of resilience during the year. It did not lose as much as other markets in March and February. However, it did not rebound as much as Saudi. UAE is what I like to call the market that has the most to lose from the pandemic, because of the large dependence on travel, hospitality, and tourism. However, it has the most to recover as well, and performed very well in the last quarter when the vaccine news and the success in the vaccine started to surface. Amar, for example, reached a bottom of around 2 dirhams in March and ended the year at around 4 dirhams, a rally of 100% from bottom towards the end of the year. Kuwait, however, we believe is the worst performing market because of first, lack of stimulus compared to other GCC markets and other global markets. In addition to the heavy concentration of the banking sector in the Kuwaiti market and the high provisioning in banks, which caused a decline of around 50% in banks' earnings in the second and third quarter, and the restrictions on, or expected restrictions on, dividend distributions. Moving on to the next slide. despite the challenges that are in the GCC economies, such as the low oil prices going forward, we remain positive on GCC equities because of four main reasons. First, because the economic recovery driven by the success in vaccination, which will ease further restrictions that are still there, such as those related to travel and quarantine. Expectations of a bounce in commodity prices, mainly oil and its derivatives, because of the higher demand after the opening and easing of restrictions, in addition to a large underinvestment in the oil and exploration sectors in 2020 because of the record low oil prices that were reached. The continuation of interest rates and economic stimulus packages in the world and in the GCC. And finally, this is creating the lack of opportunities in other asset classes, namely fixed income and real estate. In Saudi, for example, we saw a large migration of real estate traders to the equity markets, especially after the spike in VAT rates, which made trading real estate less feasible. While we expect earnings to recover in 2021, the level of earnings are unlikely to revert to pre-pandemic levels until next year, 2022. Also, we believe there will be a migration from the sectors that benefited in 2022, such as food, groceries, utilities, insurance, telecoms, consumer staples, to sectors that are expected to recover, such as financials, airlines, real estate, and hospitality. GCC economies are expected to recover in 2021. This is the GDP, not market performance. An expected GDP growth of around 2.6% is expected in 2020 and 3.1% in 2021, and 3.1% in 2022, from a decline of 6.6% in 2020. These predictions are driven by higher oil production and an improvement in economic activities. We predict that GCC economies will return to pre-pandemic levels as an economy, not a market level, in 2023. The chart below, the table below, so you can see that for full year 2020 price to earnings ratio, you see that Saudi is the highest. This is mainly driven by the positive performance of the market, in addition to the largest decline in earnings compared to other GCC markets, mainly driven by the petrochemical sector, which some of the largest companies in that sector recorded losses for the first 9 months, such as SABIC. However, you see it's the market that's expected to recover the quickest, also from the recovery in such sectors such as the petrochemicals. You see that the UAE is the cheapest in 2020, and also if we look at a forward multiple in 2022. Moving on, we expect corporate earnings to rebound from COVID levels in 2021, and believe they will reach levels to those of 2019 in 2022. COVID impact and low oil prices, most of these countries face challenging fiscal situations, especially since COVID stimulus will result in a slowdown in project spending and execution that will have an impact on credit demand and overall economic activities. Banking sector earnings are expected to continue to be under pressure, at least during 2021, given the deterioration in asset quality due to COVID, lower interest rates, which affects banks, especially those with higher CASA, because of the effect it has on NIMs, and will also affect lower credit growth and impact overall earnings. As you can see in the bar graph below, 2020 earnings, this year's earnings, both the 9 months and the full year expectations are expected to decline 25%. And then next, compared to 2019, to the 2019 level, and then 2021 earnings are expected to decline around 5%, and then are expected to recover in 2022, increasing 10% from 2019 levels. I think we're going to be moving on to the fixed income. My colleague Rasha.
Thank you, Fahad. That was a very interesting observation from your side in terms of market performance as well as the outlook. I'm glad that you addressed both the positive and the negative pressures in the market, which was quite good. As we assimilate questions from the chat, we will reserve that for the end. And I would like to now invite Rasha, our EVP and Head of Capital Markets and Fixed Income Department. What is really bad news for the economy in terms of debt and deficit is actually good news for the fixed income. We are going to be seeing abundant sovereign and corporate bond issuances, which we have been witnessing for the last few years, but I am sure the pace will pick up even with greater speed as we go ahead. GCC has some volatile CDS spread behavior that we have witnessed thanks to COVID. It also witnessed some sharp credit rating downgrades. So it's a very interesting space for Russia to explain as to how she looks at the fixed income space and what type of challenges and opportunities that she's seeing. Very keen to hear your views, Russia.
Thank you, Raghu. Okay, I'll present to you the GCC bonds and sukuk market. As all the markets, the GCC bonds and sukuk market was deeply impacted, negatively impacted actually by the outbreak of the virus COVID-19, and which also was accompanied by a drop in oil prices due to the slowdown in global economy. The effect, we can see it clearly here in the GCC sovereign yields. The yields usually increase if the bond prices drop, and this is what happened. Bond prices in March. This is when the outbreak happened, and the World Health Organization called it a pandemic. This is when, during March, the major drop happened, and we can see the 10-year treasury. This is one of indicators we use. It actually soared from, for instance, for Kuwait, for the KSA, for Saudi Arabia, from 2.96 to 3.46. UAE as well, Qatar, and of course the weakest links in the GCC, Bahrain and Oman, it increased by 300 bips and 600 bips within a couple of weeks. We also see the credit default swap spreads widened for the GCC to increase all above 100 bips. And for Bahrain and Oman, it even increased to 400 and 600, which is an extremely high levels for credit default swaps. And it reflects a negative view on the credit of these countries. The GCC credit also rating of 3 countries was negatively impacted, including Kuwait. Moody's S&P also downgraded Kuwait from Moody's from AA2 to A1, and S&P AA to AA minus, and just recently, a couple of days back, reaffirmed this rating at AA minus. However, Kuwait remains at a negative outlook, and we all know this is because of the budget imbalances or deficits that happened due to oil prices, but more so for Kuwait, it's the delay in reforms and structural reforms. For Bahrain and Oman, also there were downgrades. Bahrain, it was downgraded by Fitch from BB minus to B plus, so Bahrain is deep in the sub-investment grade, and Oman was actually downgraded 2 notches by all the rating agencies, Moody's, S&P, and Fitch. However, throughout the year, when government started the stimulus policies, monetary and fiscal policies globally and also GCC, they took certain measures to stimulate the economy, including rate cuts. We saw the market being resilient and recovered nicely and rebounded. So the same table will go, looking at the same tables, in December 20 for the 10-year sovereign yields for the Saudi Arabia, for UAE and Qatar, they all improved, and some of them even improved and it became at lower level than what we started the year. If Kuwait doesn't have a 10-year treasury, that's why we did not include it in this table. But the same happened. Kuwait has two bonds, but the same happened also for the spreads for the two Kuwaiti sovereign bonds. They recovered nicely by the end of the year. The same for the credit default swaps as well. Moving on to the next slide to see the performance of the GCC bonds and Sukuk market. Again, if you see the March, during March and April, it actually dropped. Although it started the year on a positive note, it was about probably 1 to 2% improvement in returns, or 1 to 2% recorded returns. It dropped sharply by 8.7% during March and April. But then in response to all these stimulus policies, it recovered to be the best performing fixed income market globally, better than emerging markets and better than the US and even Europe at 8.7% year to date. If we move on to, this is what, in summary, what happened to the market in 2020. It even witnessed a record number of primary issuances and in terms of value as well. The primary issuances increased by 16% in 2020 from 2019 to reach 132.7 billion US dollar of primary issuances. These were led mainly by Saudi Arabia, by UAE. UAE was 37% of value, Saudi Arabia 32%. The main issuances in UAE were sovereign. All the Emirates, Abu Dhabi, Sharjah and Dubai, they issued sovereign bonds to benefit from the low rates. Also, a lot of the banks, the UAE banks, also issued bonds, and some corporates, including DP World. But for Saudi Arabia, it was mainly sovereign and quasi-sovereign or corporates that are related to sovereigns, including SABIC, Aramco, and SECO. For Kuwait, Kuwait represented 3% of the total GCC primary issuances in 2020, being the lowest of the GCC countries, and these were primarily driven by corporates and financial institutions. Sovereigns, again, the government did not issue bonds after 2017. And if we look at the Kuwaiti issuers, they issued both in local currency, in KD, and in US dollar. The US dollar issuances amounted to 3.45, and they were mainly by banks, including Gobian, Burgan, KIB, NBK, and the frequent issuer, also Equate, came to the market to benefit from the low rates as well, with a 600 million 10-year bond and 1 billion 5-year bonds. For the KD, it's considered a pretty active year for the KD, despite the pandemic and the outbreak of the virus. It was an active year for the KD market. NIG came before COVID, but then it was followed by three: the Warba Bank, Markaz, and the National Bank of Kuwait. And we proudly say that we were lead managers for three of these issuances. So in 2020, despite wasn't a good year for the economies, it was a good year, yes, Raghu, for fixed income in terms of performance and in terms of also supply of primary issuances, whether globally or even in the GCC, to benefit from the low rates. Moving on to the next slide to take you to 2021, what are the expectations for 2021? We view GCC bonds or Sukuk actually to be an attractive asset class during 2021 on the back of an optimistic view for global economic recovery. And that is driven by mainly the continuous supportive fiscal and monetary policies globally, and also the finding of an effective and safe vaccine. We also view the rates to remain subdued and to remain at low levels. The 10-year Treasury is expected to hover around 1 to 1.5%. Which drives investors to look for yields outside the developed markets and Europe, to look for yields in the emerging market, including the GCC. And if we look at the graph in front of us, we see that the GCC actually offers a very attractive yield in comparison to other emerging markets, and even in comparison, of course, to the developed markets, but with similar ratings. So there is a yield pickup in the GCC bonds market. The GCC also is an attractive asset class because it's a fairly liquid market. The outstanding bonds stand at over $600 billion, and we think this year we'll also witness an influx of issuances, mainly driven by the government-related agencies and also by the sovereigns and the banks who want to comply with Basel III regulations. The GCC, although offers attractive yield, the bonds still it does enjoy, and also despite the rating cuts that happened during 2020, 4 of the 6 GCC countries still enjoy very strong credit rating at an A- and AA, and also despite budget deficits for these countries or any economic difficulties that they went through 2020, they still enjoy a good financial buffer, whether for substantial savings or external assets that they have. Even the weakest links that in Bahrain, considered in Bahrain and Oman, these also they do have support from other GCC countries all the time. The GCC fixed income market is viewed to be attractive as well because it's a stable and resilient market. As we have seen the previous slides, it rebounded nicely in 2020, and it did the same in previous economic cycles or crises, even in during the 2008 crisis. The GCC fixed income market performed very. For this year, 2021, is the volatility that might happen if the trajectory of growth is not going to be smooth, if there were delays, whether in the distribution of the vaccine or in delays in implementation of fiscal and monetary policies. And volatility might also happen because of certain spikes that might happen in the rates, in the longer rates. And this is on the back of positive expectations for inflation. However, we remain positive in terms of the rates. We believe that the Fed will continue to keep the rates at low, despite some accommodative inflation policies that it has and it introduced recently. So this is the challenge and this is the opportunity. So we think it's best to remain active in terms of investments, investment strategy is to be active and to look for yield. For us at Markaz, we can offer you to take or to use the opportunity to invest in the GCC fixed income market and benefit from the returns that it's going to give you in 2021 by either joining our Markaz Fixed Income Fund, which was established in 2011. Okay, for the we can provide our clients access to the fixed income market to benefit from its performance in 2021, whether through the Markaz Fixed Income Fund, which was established in 2011, and it's regulated by the CMA, or whether portfolios, discretionary, non-discretionary, or custody. As Mr. Khalil mentioned also that we have a track record since 2010, and we managed distress debt back in 2009 during the crisis. We also have a vast network of traders, which enables us to find opportunities. And this is going to be pertinent this year, looking for yield pickups and looking for attractive opportunities. Thank you. That's it for fixed income. Thank you.
All right. Thank you, Rasha. So we had some difficulty in terms of audio briefly. I think that was overall a very good news from your side that 8.5% performance in 2020 is not bad at all for an asset class with a low volatility. We are going to be having challenges going forward in terms of establishing a yield curve, I think, but the good news there is that record issuances both from the governments and the corporate will help establish that yield curve, which will enable the creation of the active secondary market, which has been the major, point of disillusionment when it comes to fixed income market. So I think we are crossing both the barriers now, and we are at a very good breakout stage in terms of fixed income. Thanks for that technical presentation, which was quite useful. We'll now move to our third panel, which is the Mena real estate. I don't know if there can be an asset class more challenging than real estate. While equity markets were parking on the back of low interest rates, we cannot say the same thing with the real estate markets, except especially the GCC, which has proven to be extremely challenging. But don't forget, it's one of the largest asset classes in GCC, on par, if not bigger than equity markets. And therefore, it's very vital to get some sense of direction in terms of why low interest rates have not helped prop up this, big market in GCC. We will discuss the same issue when it comes to international real estate, but for now, for Mena Real Estate, may I invite Bassam Al-Uthman, our Managing Director for Mena Real Estate. He has a vast and deep experience in this market, and definitely it will be very, very useful to listen to his views. Bassam, on to you.
Thank you, Raghu. My presentation consists of 2 slides. The first sheds light on the impact of the coronavirus on the GCC real estate markets in the year 2020, last year. And the second slide explores the expected market trends for this year and for the next 3 to 5 years. So what happened to real estate markets in the GCC? How did the pandemic impacted these markets? If you look at the upper part of the slide, the COVID-19 the reaction to the pandemic from the government with lockdowns and travel bans and visa restrictions impacted demand. So demand was shocked and businesses contracted, the population of the expats shrinked, and the ability and willingness to pay rental on properties was dented due to the impact of uncertainty for businesses and individuals. This demand shock affected negatively the main KPIs for the real estate market and in the GCC market. So the collection, especially collection, was deeply impacted, and the occupancy, rental rates, and valuations were impacted negatively as well. So if you look at collection, we dropped from a 95% collection rate to as low as 25%, as far as I remember, in the second quarter of last year, with some sectors recovering to a current average of 85%, and this has been improving progressively. Occupancy was impacted to a lesser extent, from a 95% rate to around 80%, then recovering to an average of 85%, and also improving with overall gain over pre-corona levels in some pockets of the residential properties in Saudi Arabia and Kuwait. The negative impact on the KPIs for the properties and for the market definitely had its effect on the rental rates and eventually on the valuations. So rental rates dropped by 5 to 15%, and this depends on the sectors, with commercial retail being the hardest hit, with signs of stability emerging in the last quarter of last year, and still it's improving since then. Valuations dropped 5 to 15% as well, and the hardest hit valuations were the low to mid residential in the Emirates, the commercial sector in Saudi Arabia, and the residential expat areas in Kuwait. So if we move to the second slide, we believe that a very challenging 2020 and correction of valuations is presenting an investment opportunity for long-term investors. So we expect the market to stabilize in the coming 6 to 12 months, and to follow that by a recovery and the start of a new cycle. If we look at the graph, we've seen two tops in the past 13 years. The first one was in 2007, and then that was impacted by the international crisis, and then we hit bottom in 2010. We accelerated in terms of valuations and rental rates, and we peaked through the years from 2010 to 2015, and since 2015, where markets were going down in terms of valuations and rental rates, and this was affected mainly by the drop of oil prices and its impact on the GCC economies in 2015, 2016. So what we expect here is most likely a stability in 2021, and then we expect an accelerated recovery, but it will definitely take some time. It will take, I think, at least next year to stabilize, and then we'll start seeing some improvements in valuations and rental rates in the years after 2021. So investing in income real estate, which is where we are focusing at the present time, generates monthly cash distributions in addition to the potential upside, especially at this stage of the market after a correction of from the peak of 2015 of 20 to 35%. So we think this could present a good time to invest in the GCC market, especially in the income generating properties. So what we are working on at the present time is to stabilize our mutual fund in Kuwait, MREF, Markaz Real Estate Income Fund, and with an objective to distribute 5 to 5.25% throughout the year. For Markaz Gulf Real Estate Fund, MGREF, our strategy is to also stabilize our operational KPIs. At the same time, we are planning to shift some assets in the fund to a higher yield, targeting a distribution of 5 to 5.5%, maybe towards the end of the year or early 2022. We are very excited about our new, we are working on a new product, also income generating fund. However, this fund will be listed on the Kuwait stock market. It's going to focus on the industrial segment in Kuwait with a target monthly distribution in the range of 7 to 8%. At this point, I conclude my presentation. Thank you for your attention.
Thank you, Bassam. The visualization is brilliant in terms of the cycle, market cycle, where you explained how real estate has its own cycle of peak and trough. And it's good to know that, the recovery is going to be not as swift as one expects, but definitely be from the low point. The travel is going to be upwards from this point of view. Also interesting to note about some of the products that you enumerated in the end, where there is a good opportunity for an income generating investment from your side. So thank you very much again. It's time to now move on to the fourth panel, which is going to be focusing on the global real estate market. While Bassam presented about the Mena real estate, we now have to focus on international real estate. International real estate is a very different ballgame altogether. And Markaz has a very, very deep and strong experience in bringing so many deals to investors, and our performance has been top-notch in this asset class. It is very important to say that we have nearly a 40-year track record in this very important asset class, and we have a very specialized team that works on this asset class in the form of our subsidiary Markaz. We have with us Abdullah Al-Mailam, who is a senior analyst in the international real estate team, and he will present us with what type of performance it encountered in 2020, and where he's seeing the opportunities and how he looks at the outlook for this important asset class. Over to you, Abdullah.
Thank you, Mr. Rago. Good evening, everyone, and welcome. So today I'll be taking you over the historical track record of our international real estate department, as well as the current market conditions and outlook of the sector as well. So if we would go to the first slide. So overall, we've had a successful track record that has spanned for 32 years, starting back at 1988. We've generated strong returns with weighted average IRR of 11.6%. We've managed to close a total of 45 deals, of which 43 have generated positive returns, mostly between 15 to 20% IRR, with 2 negative returns coming from exits during the 2008 global financial crisis. As of today, we have a total of $430 million of assets under management spread between US and European markets, and are invested in the industrial sector as well as the multifamily and office sectors. And of course, despite a challenging year we have also managed some exits at pre-pandemic levels, 4 being in the US and 1 being in Poland, giving us double-digit returns. And we've also made several capital commitments last year in deals such as in Germany, Holland, and the US. Now, this just shows you how the deal flow has continued to move and progress smoothly despite the challenging year. And of course, it boils down also to our approach as a department in selecting the right partner, and of course, our efforts in timing the market, as well as we try to be the first movers before trends are set. An example, of course, would be us pursuing opportunities in the industrial sector way back in 2014, prior to the trends being set a few years later. Now, moving on to the next slide. Now, as you can see, the 2020 no doubt has been a difficult year for the whole global economy, including the real estate sector as well. But if we were to look at it in more detail, you would see that some sectors managed to hold up strong, while others had to cope with the challenges presented by COVID-19. Now, if you see the pricing chart here, you'd see that the pricing of real estate assets such as the industrial sector and multifamily have held up strong compared to the office and retail sectors. Overall, rental growth rates have decelerated and also decreased as a result of rent rollovers. However, rates should pick up with the easing of lockdown measures, especially in strong performing sectors. Now, on the final chart you see on the right, vacancy rates overall have increased, though this is expected to be a short-term trend for the strong performing sector, especially for the multifamily and industrial sector. Now, on to the next slide. You'd see that we've ranked the sectors from least to most impacted during 2020. So industrial sector has been the least impacted, has been resilient to COVID impacts, and has seen an upward trend in demand, especially on account of the e-commerce factor. We've also seen this trend in our projects with strong tenant demand towards our product. Come second, the multifamily sector. It has also held up strong during this challenging year. We've seen strong collections and also have seen high occupancy levels in our projects. These are also supported by mostly by the government. We've also seen these quite interesting trends in one of our exits, which we have made recently or late in 2020, which we've exited at pre-pandemic levels. We've also seen in the multifamily that demand patterns have continued to change a bit, with demand inclined towards affordable stock located in suburban areas as opposed to central business districts. The office sector, highly dense offices have struggled, as I'm sure everyone's aware that work from home has become, or is actually becoming, the norm. Whereas during this year, we've also seen suburban offices attract some of the demand lately due to fewer logistical and transportation barriers that exist. Now, for the retail sector can simply be seen as the flip side of the industrial sector. You can see retailers continuing to switch their business models from physical to online stores. We also expect store closures to continue to be high as a result of the lockdowns, though Class B and C malls should see some recovery going forward. Now, hospitality sector has been the hardest hit sector, that's no doubt about that, but mostly because of the travel restrictions and the lack of tourism. Though surprisingly, we've noticed a trend which in which limited service hotels have managed to perform well, mostly driven by domestic demand. Whereas for high-end hotels, we do expect recovery to come or arrive later. Now, moving on to the final slide, the big question is, where do the opportunities lie? Now, for the industrial sector, we should see, demand momentum continuing or proceeding forward, especially in areas where the e-commerce is yet to be optimized. Multifamily, on the other hand, should provide opportunities in affordable stock, especially in markets with highly populated business districts. Now, for the office sector, it's kind of in the middle, but we should see opportunities coming from suburban offices. Retail will continue to be the flip side of the industrial sector, with very limited opportunities and possibly new and attractive business models. Now, finally comes the hospitality sector. Now, this sector is quite interesting because today you have assets selling at 30 to 40% discount pre-COVID-19 levels, or in other words, below replacement cost. Now, opportunities can be found here in abundance that could provide very attractive returns for investors as the market gradually recovers. Now, it is also worth mentioning that we are close to finalizing several deals in that sector that are expected to provide investors with double-digit returns. And of course, our focus does not end here, but we are also close to securing deals within the multifamily and the industrial sector as well. Thank you all for your time, and please do feel free to ask any questions, as the team and I will be happy to address them.
Thank you, Abdullah, for your perspective on various categories within the international real estate, especially how you looked at the industrial, multifamily, office, retail, and hospitality, and you provided your views on these sectors. I'm sure we'll address some of the questions later, but now we will move to the last panel, which is the global markets or international investments. International investments, as you know, as the name implies, focuses on asset allocation because it has various asset classes embedded within it, including global equities, global fixed income, emerging markets, alternative investments, hedge funds, private debt. So it's a very, very vast area. But a lot of clients have global portfolios, and both the equity markets and the debt markets globally have been on a bull run for the last so many years. You all would be aware that S&P 500 is now on its 10 plus years of bull run, and bond market even more. It's the 35th year of bull run for bond markets. The yields have dropped from 8% to almost 1% now on the yield curve. So it's a very interesting landscape. We have with us Abdul Mohsen Al-Mudaf from our international investments team, and he's going to walk you through in terms of how he sees the past performance or what happened in 2020, and what's his outlook for 2021 and where he's seeing opportunities. On to you, Abdul Mohsen.
Thank you, Raghu, and good evening to everyone. So we're going to go through multiple things, obviously, as Raghu mentioned earlier. We'll start with the storyline in 2020. We'll talk about the timeline and some of the events that unfolded there, and then how that carries us over to 2021 and our beliefs going forward. So towards the end of the year in 2019, the genesis of all of this began. We began hearing first reports of a new virus in China, which initially had no effect on the major indices within the US markets. However, shortly after, we began seeing that those all-time highs were soon to be short-term lows very soon. In the end of February, leading into March, we began seeing acknowledgement from many governmental bodies, mainly, of course, the Federal Reserve Chairman himself, releasing a statement pledging to act as appropriate in the face of the pandemic, and indicating that the Fed and many institutions similar to it would act as appropriate to be able to address some of the situations pertaining to the outbreak. We began seeing many initiatives being put into place, namely, of course, interest rates were cut to near zero, but we began seeing other things being inputted into the market, things related to liquidity, whereby the Federal Reserve was engaging in large-scale asset purchases, as well as many lending programs through things such as the Payment Protection Plan and stimulus checks as well. This injection of liquidity provided support for equity markets going forward, and we began seeing that being evident very quickly. The first of which we began seeing in the tech sector, where a lot of the lesser affected companies began seeing a lot of outperformance during this time. Companies such as Zoom, Peloton, Netflix saw a lot of outperformance during this time because of the nature of the companies themselves. And then we also began seeing a trickle-down effect into some subsectors like electric vehicles, spearheaded by Tesla, clean energy as well, which was a derivative of the Biden presidency, and then some private to public companies as well through IPOs and SPACs, companies like Airbnb, DoorDash, so on and so forth. Moving on. What we look at going into 2021 will address all the different asset classes that we're looking at, but we'll start with the equities since we talked about them earlier, spearheaded by the US, of course. We have an overweight outlook on US equities going forward. We believe the environment is very accommodative for them. We believe that the combination of interest rates, as well as a willingness by the Federal Reserve and other governmental bodies to provide support for the markets, provides a very good tailwind for equities going forward. We also see a lot of continued growth within the indices, the S&P 500, of course, but we also see some very secular shifts towards the Dow Jones and some value-based companies, as well as some small caps as well, which are going to benefit from the structural growth trends that 2020 has left behind. Going towards Europe, we are more neutral on European equities. This is for many reasons. However, the main of which is due to the exposure of European equities to more value-based companies that have similar exposure to financials amid the very low interest rate environment. This, in combination with the fact that the COVID-19 pandemic is still very much alive, economies are still locked down, the potential of which to continue is still alive, we remain neutral on European equities going forward. However, with that being said, some spotlight should be shedded on the ECB's handling of the pandemic up to this point. The European Central Bank has made sure to provide a lot of support to many of the economies within the region, which could lead to a vaccine-led revival at some point in the next 3 to 6 months. Moving on to emerging markets, actually, could we go back one slide, please? For emerging markets, we see ourselves overweight emerging markets going forward. The main reason, of course, being that China, spearheading emerging markets, has had an economic recovery that is positive in relation to some of the other developed markets that we have seen and mentioned, as well as the fact as them being beneficiaries, as well as other emerging markets nation, to a weak US dollar and more stable geopolitical climate going forward. China's tech orientation also provides some benefit here for the aforementioned growth trends that we talked about earlier. Moving on. When we look at fixed income as a whole, we are neutral on the asset class. However, we do see some bright spots, and we do see some areas where we could potentially move away from in the future. Yields today are fairly compressed amid the low interest rates. We also see a continuation of uptick in default rates going forward, which takes us away from some of the asset classes or regions such as investment grade credit, which we are underweight on. However, it does bring us toward stuff like treasury inflation protected securities, which could be beneficiaries of higher inflation going forward, should monetary policy continue and provide an uptick in inflation. We also are overweight global high yield, as we see them being the most attractive source of income within this yield-deprived world that we are living in today. And then also we are overweight Asia fixed income because of the valuations there and because of the aforementioned point about Asian economies being a lot better off in terms of their recovery than some of the nations we had talked about earlier. We mentioned inflation as well, and we could potentially see an uptick of inflation going forward within the economy as things begin to settle in. Because of this, we are looking at certain assets such as inflation-linked bonds and a lot of alternative storage of value away from the US dollar. Of course, the kind of the hot commodity, if you will, today is cryptocurrency, but we still believe there's some value within gold and foreign currency as well. Moving on. So I'll talk about us a little bit as a team here. We've been active for more than 20 years within Markaz's more than 40 plus year existence. During this time, we have navigated through multiple economic cycles, namely, of course, the global financial crisis in 2008. But we've also been around during the dot-com bubble, the flash crash, things of that nature as well. During this time, we've made sure to provide many products and initiatives to our clients, emphasizing our relationships with those same clients and making sure to bolster our relationships with other third-party managers along the way. In doing so, we've been able to provide products over the years bilaterally with a lot of those third-party managers. We've partnered in things such as broker and custodial services, as well as providing a lot of products in partnership with those same managers. Today, we place a huge emphasis on research and due diligence as part of our investments, as we've mentioned earlier on during the webinar. And we've made sure to engage with those same third-party managers to be able to provide a portfolio service to our clients bilaterally with some of our world-class asset managers to be able to leverage both of our knowledge and theirs in order to benefit the client going forward. We also believe that we act as a single point of advice through multiple different asset classes, thus being able to provide adjusted returns over time. This is us and this is the markets. This is what we have to talk about. I'll leave the floor to Rago and the rest of the team to continue the webinar.
Thank you, Abdul Mohsen. A single point of advice is probably the most important thing from your team's contribution to clients. We have covered all the asset classes. I would request participants to type in their questions if they have any, while I try and summarize what are the key takeaways from all these presentations. All right, so we started with Mena Equities. They have presented a low single-digit type of an outlook for the equities market. Fahad was talking about economic recovery and rebound. On the back of oil price recovery, because oil price did fall through quite sharply, and when the global economy recovers, oil price is also expected to recover. And the Fed also made a point about low interest rates supporting the markets. And though he was not very bullish on earnings recovery, he was a bit cautious about earnings, and that probably is why he was penning an outlook in the low single digit for Mena equities. I'm sure it is going to be very interesting 2021 from an earnings point of view. We will continue to watch how various sectors will respond to earnings. Moving on to GCC fixed income market, which was presented by Russia. She was emphasizing on the good returns that the asset class has produced in 2020, and how she's very optimistic going forward in 2021, because she believes that the market is fairly liquid and it's a stable market, and the credit ratings are top-notch for GCC markets. When you look at it from an emerging market basket point of view, I think the yield pickup is quite sizable for a similar rated bonds, and therefore the attractive yield differential is what she has argued as the main uptick for GCC fixed income. She continues to forecast good issuances on the back of corporates and, more importantly, governments, which will have successive deficits, and therefore they need to issue bonds. Then we had Bassam presenting about our Mena real estate. He presented a very interesting cycle concept, and he believes that we are at the bottom of the cycle, and from here we can look for recovery, but he expects a recovery time of about 6 to 12 months. And then the new cycle will begin. But he was also very cautious about roadblocks and vaccine rollouts, oversupply by real estate players, and weak consumer sentiments could delay the economic recovery a bit farther than what we all can anticipate. So that's a very cautious outlook from Bassam on GCC real estate, though he outlined some fantastic product ideas in terms of industrial REITs and good income generating opportunities within this asset class. As I said, this is a very complex asset class, even though it's a very big asset class. So it's unlike equity markets, which are getting energized by just one factor, which is low interest rates. Here there are multiple factors at play, and it becomes a bit difficult to analyze. But however, it is very optimistic to note that there are opportunities here, and he is ready to seize them as and when it presents. On the international real estate side, as I said, we have extremely deep experience in this asset class, and when Abdullah was presenting about various sectors within that, he was quite bullish on industrial and multifamily, mainly on the back of economic recovery, but he was also a bit cautious about hospitality and office space and retail, because while COVID goes away, hopefully, but still people will not take to the airports and start traveling as usual. So business travel will still be slow to pick up, and therefore outlook on hospitality and thanks to e-commerce, retail will also find it difficult, and at best can come back. Especially I like his outlook on retail, where he expects it to at best come back to pre-pandemic level and not any further. But overall, again, a very interesting set of ideas and opportunities that he presented to capitalize on global real estate. International investments, Abdul Mohsen navigated the toughest aspect of the asset class, because so many things that are subsumed within that. He is bullish on global equities, like most of the investment banks, on the back of course, Fed's very low accommodative interest rate policy. Therefore, he's bullish on overweight on US equities. He's sort of neutral on European equities, but again, he's placing his bets on emerging markets, which offers a lot of structural value, as we see, because global markets represented by S&P 500 is a very tech-heavy market, whereas emerging markets are a bit more balanced in terms of the opportunities that it offers. So that's a point that well noted from an international equities exposure point of view. It was really interesting to hear his views on the fixed income market, where he's sort of neutral, because he fears that the rapid yield compression from here might only result in yields going back, and therefore when that happens you will have probably some challenging times. The point about the default rates increasing is also a very, very pertinent point from him, because if you notice, 2020 was awash with issuances from corporates on the fixed income market. They have raised money as if there is no tomorrow. And ultimately, when you have such a heavy issuance of corporate bonds, naturally the pressure on default rates will definitely show up. And thanks to him for pointing that out. He was also very cautious about inflation. He fears that inflation might come back thanks to the huge fiscal stimulus, and if that is the case, he presented tips as an opportunity to look at, which was quite interesting to note. So overall, I think the takeaways have been fantastic from various expert point of view, and I think it will be useful if you can grab a copy of the Outlook, and we will shortly be coming up with our house views on these various asset classes, and we'll be very happy to be in touch with all of you. So with that, I will now request Abdul Latif to pick up some questions. I do see some questions here. Abdul Latif, if you can direct it to the concerned experts at Markaz, and probably take over from this point of view. Thank you all for making an excellent presentation.
Thank you, Raghu. So I have a question here for Ali. Does Markaz prefer global equities over MENA equities for post-COVID years 2021 to 2023? This is probably more of an asset allocation question in terms of the general investments at Markaz.
Well, thank you, Abdul Latif. As I started our webinar here, saying diversification is going to be critical, and there will be greater diversity in performance between asset classes. So no, we do not prefer MENA equities over global, nor global over MENA. We like equities overall, and we focus a lot more on the selection of sector and companies rather than on geographic arena. Moving forward, I believe knowing what to choose as sectors and companies within sectors would make a... Sorry? Yeah, will make a lot more difference in performance and alpha rather than just geographic asset allocation.
Thank you, Ali. And then another question for equities, maybe for Fahad, Rashid, or Abdul Mohsen to touch on. Will equities regain appeal with investors globally?
We actually believe equities did not lose appeal in 2020. the opposite of that actually happened. If you look at markets such as Kuwait and Saudi, traded values were higher. Percentage of values compared to free floats of markets actually increased both in Kuwait and Saudi, in Abu Dhabi. We saw some decline in Dubai, but we think low interest rates provide cheap money and make opportunities very hard in the fixed income, thus driving volumes into the market. And we believe higher trading volumes will give markets an advantage in the following year. So we believe the appeal was there in 2020 and will continue to be there in 2021. That said, GCC economies remain challenging, fiscally at least. However, the market appeal, we believe, will continue in 2021, or at least until interest rates start increasing again.
Okay, thank you. And then one for Abdul Muhsin. Does Markaz invest in Bitcoin?
So the quick answer is no, but we're always exploring possibilities and opportunities through multiple different asset classes. We mentioned our relationships earlier with our world-class asset managers that we've fostered across the years. The opportunity is always there. However, for the time being, we're not directly invested in them, no.
Okay, thank you. There's one from Mohammed. I'm assuming this is for more on the local front, maybe Bassam or Russia can take that. Will stimulus package be needed to restore jobs and save businesses, particularly SMEs, in 2021? This is a tough one.
Tough one, Abdul Latif. I think, do you think Raghu, because he's the most neutral among us, would want to have a shot at it?
Ali, if you notice from a stimulus point of view, Kuwait has probably hasn't done much on the stimulus as much as other GCC countries. This probably explains the market performance as well. So while the whole world is, after stimulus as a medicine for economic recovery, Kuwait has lagged behind on this, and therefore, if the gear shifts to stimulus in Kuwait, probably that will be a huge plus, not only for SMEs, but for even other big sectors in Kuwait. I think it's a good question and a good point, but that's a policy discretion, and nobody can give a shot at how that will, in which direction it will move.
Yeah. Can we, Raghu, I mean, maybe it's worthwhile spending 30 seconds. The proxy, what would have happened in Kuwait had we had a big stimulus package? And the proxies would be probably Saudi Arabia. What would be a good proxy, an economy that has really injected liquidity in the market?
Yeah, actually, if you look at the impact of COVID, it's more, of course, it's on the oil GDP, thanks to the crash in the oil price. And the non-oil GDP. Mainly, I think I'm more worried about the non-oil GDP. And this is where the job losses are happening. This is where bankruptcies are happening. And we need to find a way to really pep up this non-oil GDP, and fiscal stimulus is one of the easiest way. Otherwise, what will happen, your question on what would have happened if there was a fiscal stimulus, obviously two things would have happened. One, you would have encountered a faster economic growth, especially the non-oil GDP side. And secondly, the NPAs in the banking sector would have been far lower. Now we have to grapple with higher NPA levels that will take a longer time to get off the books. Remember back in 2008 when we had the global financial crisis, we had a similar movie playing out. And this time as well, we have to be conscious of the fact that banking sector is one of the biggest sectors, and they are the conduits to SMEs and other industries and firms in terms of working capital and sustainability of business models. So if banks face a huge NPA pressure, that is going to show up on the broader economic revival as well. So the theme is economic recovery and revival in 2021, and how best one can achieve that at the quickest possible time in order to prevent further job losses. I think that is where the focus has to turn. Monetary levers have a very limited headroom from this point forward, and you only have the fiscal levers, and people should use that very quickly and wisely.
Okay, thank you. Then a note here on international real estate. I think Abdullah Al-Mailim had touched on several asset classes. So since 2015, we have predominantly focused on industrial with an average weighted IRR probably of 15%. And then 2019 and 20, where we had great exits. And unlike others, 2020 has been exceptionally kind to us, where our IRRs were between 15 and 20% investing in industrial real estate. So I'm going to move on to a few. We're going to take a few and then we're going to wrap it up. Will markets be affected with UK paying out of EU membership? And then another one for Bassam on Kuwait real estate. What's your expectation for Kuwait real estate, and then for GCC real estate? Raghu, do you want to take the first one?
Yeah, sure. UK Brexit, as you know, because of the confusion in the Brexit, probably UK has been a negatively performing, or only one few negatively performing global markets in 2020. Moving into 2021, I think a last minute late deal with the EU salvaged some problems for the UK, but the road in 2021 for UK is still going to be an year filled with negotiations. So they not only have to negotiate with the EU, but they have to negotiate with the rest of the world. So that is going to be a big, it will keep them engaged on that track for a while before the things stabilize. But we should not forget the fact that UK is a huge market, and definitely they have a big trade impact with many countries in the world. But I don't see the road as a very easy road to navigate in 2021. So within the developed markets, I think people would continue to be a bit cautious when it comes to asset allocation for UK and EU in general. Plus, EU has also got other problems with respect to negative interest rates and what have you. So those also have to be taken into account. That's why I noticed that Abdul Mohsen has been neutral on Europe, while he was overweight on emerging markets and US equities. So I would go with that.
Okay, and then Bassam maybe on Kuwait and GCC real estate expectations.
What applies to Kuwait, to some extent, applies to GCC countries. We see stability to the real estate market in GCC and Kuwait. Still, you have the negative impact of the coronavirus is working its effect on these markets negatively, definitely. But yet at the same time, you have positive forces or drivers where higher oil prices, lower interest rates, growth in GDP. So between the negative impact of the corona virus pandemic and the positive impact of these main economic and financial drivers, we think the markets will stabilize this year and most likely improve in terms of the underlying key performance indicators.
Thank you. There's one more, I think maybe Ali can take that. What will be changing scenario with Biden administration coming in with new policies and new arrangements globally?
Thank you, Abdul Latif.
Sorry, Ali, there's a follow-up also. Markaz, what does Markaz prefer in terms of international real estate, UK, US, EU? Sorry, go ahead.
Okay, I think there are two questions here. The first one, what change do I see? I think definitely there will be a slight change, higher taxation, more spending, which will adversely impact company earnings, but I think offset by more fiscal spending, and that should encourage basically demand within the US. So overall, I believe I don't see much change in valuations or appetite for equity. I believe the much more important driver of performance moving forward is much less, Biden, and it's a lot more how technology is impacting individual companies and how will we, in effect, adapt to COVID. As to the real estate, I would like to defer to my colleague, Sami Shabshab, who has very close to 25 years experience working together on real estate. Maybe Sami, you can take that.
Yes. I think as far as sectors, I think the industrial sector will continue to do very well for two reasons. First, the tenant demand is there and is very strong, and the capital demand allocated to industrial is very strong. I think this sector has performed incredibly well in general because of online and other retail dislocation, but COVID also helped tremendously, where the ratio of the percentage of online to overall retail jumped from 11% to about 20% within a period of 2 months, which has really added fuel to the to the industrial sector. We think that would continue to do very, very well. Multifamily will do okay. We think it's tied to job growth. It would be stable, we believe, unless there is some severe recession. Now, in the US, just one thing, the COVID vaccine rollout is slow. And on the industrial sector, we're not worried about that because it's a positive. It could affect somewhat the multifamily, but again, as Ali mentioned, it's very market specific. In every class, even within industrial, it's market and sub-market specific, and within a sub-market, which specific asset you pursue. But that's in general where we see the market.
Thank you, Sami.
Abdul Latif, if Sami, I think I know what your answer is going to be, but between the US, UK, and Europe, what would you do? How would you allocate? Because we're really active in all these markets, and we're now close to entering the UK market. So what would you say?
Yes, I would say probably 50-50 between US and Europe, and I would still say the focus should be industrial. Industrial in Europe is a little bit behind the US, and I think there's room to grow there. Yeah. And I will certainly not bullish on office because of COVID and how it will repurpose itself, and people now are used to working from home and and it's very efficient. We've gotten used to it, and there's many things that we will continue to do online. But in general, to answer your question, I would say 50-50 between Europe and US.
Thank you, Sami. Sami, you're based in California, of course, heading Markaz and overlooking the US and Europe real estate operations. We have two follow-up questions here. One from Mishari. For the housing market, what do you recommend? Hold, buy, sell? This is probably multifamily. And then another one on hospitality and tourism. When hospitality and tourism sectors will be back to the normal cycle?
Yeah, let me start with hospitality. Hospitality, we think, is where an opportunity does exist, and we'd like to pursue it, because we think, although hospitality, which is hotels, may not go back to pre-pandemic level, but it's been beaten up way worse. And we think with the rollout of the vaccine, although in the US slower than Kuwait, and we think hotels would recover within a year or two. Again, maybe not to pre-pandemic level, but there will be a recovery that we think we can benefit from. And as Abdullah mentioned, if you're buying it at roughly 50 or 60% or 70% replacement value, and you are with limited service hotel where there's not a lot of restaurants and other amenities, I think that would do very well. We're looking into that. And as far as multifamily, we think it's good, it's solid. We would keep an eye on job growth in certain markets. And we are, in fact, developing a project in Phoenix that we think will do pretty well. The market is underserved. If he's talking about the housing market, again, it's not something that we do, but interest rates have been very helpful. They're at record low, and that's what really drives the housing market. So I think that's how we feel about it.
Thank you, Sami. Is this the right, currently, is it the right time to sell equities and reinvest in fixed income instruments? And then another one asking Markaz, does Markaz hedge to reduce its risk? And does it inform investors about hedging?
Latif, can I take the second one fairly quickly, because it's a matter of policy. We believe that it's up to the client to hedge, and only if we're asked to hedge. But normally we don't hedge. If we want to hedge, we just reduce our allocation to the respective markets. We don't use derivative instruments, although we started the exchange traded options back in the early 2000s. We will not use it in portfolios unless we are directed to do so. And nor do we leverage portfolios ourselves. If the client wants to leverage, that's fine, but this is not a policy of ours. Okay. And equity versus fixed income, go back to you, Abdul Latif.
Yeah.
So I can take part of that one, Abdul Latif, if you'd like. Allow me to market one of our products in answering this question. First of all, of course, it's an asset allocation, and I cannot make that call. But if the question is about comparing yields in equities versus yields in fixed income, we launched a product 2 years ago, which is a dividend yielding equity portfolio. And in that portfolio, we were able to, in 2020, we were able to pay a dividend of around 5.5% cash dividend to our clients, and close the year making a total return of around 3.5% for our clients. So if the question is about whether the client wants an option that yields cash, I believe we have an alternative to fixed income in that sense. However, the question remains an asset allocation question.
Interested to hear the views of Russia actually on this one as well.
Whether fixed income or equity, it's a matter of asset allocation and risk tolerance of the client. First of all, we always encourage clients to increase their portion or their investments in fixed income, or at least to have a percentage in their portfolio, because fixed income provides income, definitely. That's why people invest in it, and it reduces the risk of the total portfolio. Definitely the risk of fixed income is lower than that of equity or that of the real estate as well. So it reduces the total risk of the portfolio. And it helps with diversification. So we always encourage investors to have a portion of their total portfolio in fixed income. And as I have shown in my presentation that the prospects for fixed income, especially GCC this year, is going to be very positive on the back of lower yields in developed markets. This is going to be an attractive region. And we expect inflows to come from international markets into the emerging, and most specifically to the GCC, as it composes around 70% of the emerging market index. So yes, we do positively view the market this year. So in terms of performance, it's going to perform well, and in terms of also risk diversification, it's a good instrument to have in your portfolio.
Yeah, thank you, Rasha. I really have to add here also, the fixed income would have made a much larger percentage of portfolios in Kuwait and the GCC had the market been more liquid. Now, with the inclusion and basically, with the inclusion and the index, emerging market index, including fixed income from the GCC, we see greater appetite. Now, let me give you an example. The last major bond that was launched was NBK, and I think it was it sold at 4.75% fixed and 4.5% floating. When you consider that, it's and compare the spread of that to a US dollar bond of equal rating, this is a very, very attractive spread, and I don't think it will last very long. So there is an opportunity this year to make a return on fixed income because of the anomaly in liquidity, and because it's going to be included and more thought after, higher than what it usually is. So we're likely to see higher return than what it should give had it not been for the liquidity and the inclusion.
Okay, thank you, Ali. There's one more from Gopal. There are a few sets of questions. I'm going to pick one. How important will be tactical allocations in your management of portfolio?
Yeah, I can take this one, Abdul Latif. When it comes to asset allocation going forward, I'm sure we're not alone in thinking this way, but in 2021, most investment managers and investment banks have opted for a more active approach going forward, especially for this year, where we are still expecting a lot of volatility towards the end of the year. Because of this, I think a more active management style here is appropriate. With that being said, just to go off of one of the points we made earlier, our portfolio services, especially as of recently, have incorporated a more active style. This is to be the beneficiary of the points we mentioned earlier going into the end of 2021.
Thank you. Does Markaz invest in Pfizer and Astrazeneca?
Yeah, I'll answer that one again. So indirectly, yes, we do. Underlying some of our funds and ETFs, there is always an allocation there to healthcare, not just in Pfizer and AstraZeneca, but to the healthcare universe as a whole. So we have been able to gain some of the positive performance associated with the vaccine there.
Thank you, Abdul Mohsen. I don't see any more questions. I think we've covered a good set of them. Well, to wrap this up, thank you very much for attending. We're gonna circulate a survey just to know how we've done. There's plenty of room to improve as always. And we thank you for listening. I've included my email. If you have any questions or comments in the chat thread, please feel free to reach out. And for those that have requested a copy of the presentation, we will circulate that. Thank you very much. Have a safe 2021. We're very bullish and optimistic. We think there are great opportunities. We're in the value, or we're in the business of adding value to clients when there's turmoil and when markets are volatile. And I think we will continue to serve our clients as good as we did in 2020 and even better. Have a lovely evening, and thank you for joining again.